Hey guys, it's Mark here from ETF Tracker. This is the ETF Tracker Show, and in today's episode of Interviews with Experts, it's episode number 6. We're talking with Matt Holberton of Fidante. They have 2 fixed income active ETFs, so we're going to learn more about that, his views on the market, and just a whole lot more. So check out the show. All right, welcome back, guys. Here we have an expert in the fixed income space. We've got the honor of having Matt Holberton join our ranks here at the ETF Tracker Show. Matt, welcome.
Thanks, Mark. It's a pleasure to be here.
Fantastic. So for the viewers who may not know about you, I always like to ask all of the guests to do a bit of an intro. Tell us how you got started in the financial markets. How did you get to Fidante? And can you tell us a bit about that?
Yeah, thanks. Okay, Mark. Look, it's a pretty easy story, actually. I guess it runs in the blood. It's in the family. My grandfather was in banking. My father and his brothers were also in sort of banking, whether it was commercial banking or investment banking or even financial journalism. So I was exposed to financial markets, economics, commerce at a young age, and so I followed the natural path through university, Bachelor of Commerce. And then I got working in 2005 at a boutique merchant bank, and from there worked through different banking products, and whether it was sort of margin lending, securities lending, cash management trusts, multi-currency, and then eventually that led me to Fidante back in 2018, where I currently head up distribution for listed products, and that currently includes things like ETFs or active ETFs, which we'll talk about, I'm sure, a lot more today.
Yeah, no, definitely. That's fascinating because some people come from very different kind of backgrounds. I came through the data and technology route, and I had another guest that was similar. Others have been more kind of traditional routes. It's interesting to see that you've had it run in the family. That must have been interesting growing up.
Yeah, absolutely. I guess understanding, and reading the financial review, understanding things like reporting season, and also just politics. Understanding the impact that economics has on politics, and we had some fantastic innovations or changes to the Australian macro landscape in my sort of childhood. Things like super, which was brought in when I was very young, and that's paved the way for this industry today. So we have, I think, one of the world's largest, one of the most envied, retirement sort of superannuation schemes in the world.
Yeah, absolutely. I think last time I looked, it's like the 4th biggest in the world, like this little minnow island of Australia.
It is, really punching above its weight. Yeah, it's fantastic.
Crazy. We have,
and it employs a lot of people too. That's the other thing. I mean, think just how many people are involved in this sector, whether it is people directly involved in superannuation or managed funds, stock exchanges, the companies themselves. It's been a win-win for everyone.
We're a pretty big market. That's for sure. So jumping back into Fidante, and you mentioned ActiveX, and you've got the shirt on. We love that.
Yeah, can you see that? Yeah. So ActiveX is the brand that we use for our active ETFs.
Mm-hmm.
So Fidante was established inside Challenger Financial Group way back in about 2005 to house boutique funds management businesses. And currently we manage about 85 billion across 18 boutique partnerships. So what typically happens is we find an exceptional team, lift them out of an institution, back them, put equity into the business, working capital, and then we go and do things like help them raise money, manage the back office. So the investment team themselves, the portfolio managers, the analysts, they can stay really focused on research and managing portfolios. So we take care of everything else, and we've done that multiple times over the last decade or so. And as I said, 18 boutique partnerships today, and that's growing.
That's brilliant. And you guys both. So sorry, go ahead.
Yeah. Oh, yeah. So it's just to round out the ActiveX thing. So ActiveX was started in late 2018. We launched our first active ETF called XARO, the ActiveX Real Outcome Bond Fund. and that's now got about 792 million. I'm just checking my notes there as of 2 days ago.
Wow.
It's the largest fixed income active ETF, and it's one of the largest exchange traded products. In fact, for in terms of the flows that it's been getting, which has been fantastic. We have another one called XKAP, which is listed on Chi-X. That's the ActiveX Capstream Absolute Return Bond Fund, and that's been on the exchange for about a year or so less than XARO. Hasn't had the same whopping success, but in terms
not
of
yet.
7 million, but not yet exactly. It's early days.
Yeah.
But as we'll talk about further, we have really reached a bit of a tipping point in the industry with active ETFs, and I think there's a lot of innovation coming with fixed income. So so ActiveX, just think of it as a brand name. We're an active manager. We believe in active management. That's not to say we think that passive management doesn't have a place, but we are real believers and nurturers of active managers. And ActiveX is simply just that brand name for our active ETFs. And watch this space. There'll be hopefully in the next 12 months another couple that we'll bring to market.
Oh, brilliant. Well, I know very well that whole kind of company and then different brands underneath it, like ActiveX. I mean, ETF Tracker itself is a brand under the main kind of company. So, that's our kind of talking piece for ETFs and continuing those conversations like this. But, on that ActiveX and those fixed income ETFs, the two that you've got, I mean, I see inflows. XARO is always up there in terms of high levels of inflows, and very recently, I think it cracked top 5 or something like that I saw. But can you tell us a little bit more about for many viewers? I mean, I think it's just because of sheer knowledge of most people know equities and they see companies in the news. They don't talk about fixed income too much, but some people might not know that there are fixed income ETFs. How do they differ to equity and other types of ETFs? And the question here is, how do they get used in a portfolio?
Yeah, so look, I guess they don't make the headlines like companies do, and Australians have been stock pickers or stock investors for a very long time. I guess it goes back to even the gold rush. We've just always had that that desire to invest in things that are perhaps speculative or growthy, or investing. I guess at the end of the day, you invest in things that and bonds, government bonds or corporate bonds, just aren't really part of the everyday lexicon, are they? You don't really talk about, oh, did you hear that German government bond? Did you see what happened overnight? It's not. It's really a small subset of the market or society that talk about bonds, but it's actually a much bigger market and probably more important than the equity market. So what we've seen over the last, say, 5 or even 10 years is a little bit more focus on fixed income from the average investor as they look to diversify their portfolio. So you can, but it's probably not considered best practice to be 100% equities. You might want to always keep a little bit of cash for a rainy day for when markets perhaps fall, and you want to take advantage of that dislocation and buy some more equities. So typically portfolios will have part growth and part defensive. Fixed income's typically been made up most of that defensive allocation. In the past, you'd have also had a bit of cash, but because cash rates are so low, it's very hard to hold pure cash. So fixed income is simply just investing in debt instruments or debt securities, things like government bonds. So they're bonds issued by governments around the world, and corporate bonds are bonds issued by corporations. And they promise to pay you a coupon at a set interval, or possibly right at the end of the cycle, the life of the bond. And then there is a maturity date and the bond is repaid. So if you invest $100, you might get a 5% coupon for, say, 10 years, and then after 10 years you get that principal back. And so look, there hasn't really been a lot of new product in the ETF space or in the active ETF space until the last couple of years in fixed income. And I think, yeah, the reason why it has been popular is because investors were starved for choice before that. And there are a number of products that are hitting their objectives, that are delivering great outcomes for clients. And I can talk about the ActiveX DAIA Real Outcome Bond Fund just for a second. So that targets, simply this targets a 2% above cash with a 2% volatility budget. It's a very, very smooth ride, very low volatility of returns. It only invests in government bonds and cash and derivatives. So 90% of the portfolio is in, sort of AAA, AA rated government bonds. Great. They look for mispricings between those instruments, and they do use derivatives to isolate mispricings. You think of them as an arbitrage type style of investing, but yeah, very low risk, and that's been really popular with investors because yeah, cash is not returning much. Some of the conventional fixed income strategies haven't been perhaps doing what they're designed to do. So there's a lot of interest rate risk in the index at the moment. What that means is if interest rates were to go up, you expect some pretty large capital losses. So investors have been piling into more sort of shorter duration assets to minimize that risk. But if you're on the other side of that, if you actually pick when you think interest rates are going to fall, you can actually make quite a lot of money when the price of bonds increases. So that's this concept called duration. I'm sure you've heard that before, and others have. What is that? It's simply just the sensitivity to a bond's price to changes in interest rates. So when interest rates go up, bond prices go down. When interest rates go down, bond prices go up. But that is a very sort of a binary outcome. And there are other ways you can invest in fixed income with sort of taking that risk out or trying to minimize that risk. Things like looking at floating rate instruments, whether they might be corporate loans or other floating rate notes. That sort of takes the duration risk out, and you're just then playing pure credit risk. So yeah, I do expect more and more products to hit the boards over the next year. I've heard from our good friends at Chi-X that we've got quite a few on the way, and also I think at the ASX, there'll be a lot more coming to market soon.
Oh, definitely. I mean, with the CBOE kind of buyout of Chi-X, I'm hoping and expecting to see more products there, and similarly from the biggest exchange, the ASX. Now, you mentioned all of these terms that viewers may or may not know, but we'll make sure that we include some definitions in the show notes there. But, mentioning like the fixed income side of things of ETFs, right? Everyone's so used to equities. Not only are you guys doing fixed income, which some people may or may not know already, and they should, because as you said, it's a very good defensive kind of hedge against any kind of market volatility, right? But you guys are also doing active. So that whole active versus passive with ETFs, I've spoken about it before. I've had other people speaking about it, but what are your thoughts on that? Do you see a place for both in portfolios?
Yeah, absolutely. Even though I wear this shirt and it says ActiveX, it doesn't mean that don't believe that passive has a place. And just for your viewers, I mean, passive is simply where you track an index. There's also sort of smart beta, which is another sort of a smarter passive strategy, perhaps you might call it, where it tracks quality factors or momentum, or it might be sort of thematic. They've been really popular, and they have a place because sometimes you may not have time to go and select an active manager. There are so many active managers out there. Like, how do you decide which one to use? So they can be, that can take you a bit of time. If you just want immediate exposure to something, they're a fantastic way to do that. And then even beyond that, within a portfolio, you may not want to have all of your investments run by active managers because of cost. You might want to keep your sort of fee budget to a limit, and that's why you can use both, because passive is obviously cheaper than active. So yeah, you've probably heard of a core satellite approach that's been very popular in the financial planning space, where you might have your core investments that are passive, lower fee, and then satellite investments are active managers that obviously charge a management fee. Perhaps they charge a performance fee, which I personally don't have a problem with for a lot of assets. Although for a defensive fixed income product, a performance fee is probably not appropriate, because the managers shouldn't be reaching for returns. They should actually be managing to a risk budget. So you don't often see performance fees in sort of defensive fixed income or defensive assets. But certainly for equities, I think it can be really appropriate and really motivate and incentivize and align the investor with the investment team.
Mm-hmm.
So yeah, look, I definitely think there's a place for both. And so I get a bit sick of the old argument active versus passive, because it really is both. You can have both in your portfolio. I personally do, and I've seen some of the smartest minds out there, some of the the best portfolio managers or CIOs that I admire will have both in the portfolio. So yeah, definitely don't believe it's one or the other.
Perfect, and great to add your view to the many that are out there, and I'm in line with you. I definitely see room for both there. Now, touching on that, what goes into the portfolio, and you mentioned a few things about the satellite and core and defensive and growth. These are things that people are seeing and they're interested in, because they want to know, well, I'm trying to get into ETFs. How do I assess an ETF? And I've told people to look at, a couple of different things, but I'd love to get your opinion on that. How do you, when say someone talks to you off the street and wants to know about how to assess an ETF, where do you start? What do you look at?
Yeah, great question. So I would start with, okay, what is your objective? Are you saving for a house? Have you already got a house? You want to diversify your wealth?
Mm-hmm.
Have you just got a bit of money that you want to invest and, shoot for the stars? So what is your objective, and then what is your risk tolerance? So if you are saving for a house or something, or deposit, and it's maybe over a 1 or 2 year time horizon, perhaps you don't want to just aim for the stars and risk everything, because if things were to go south, you could lose a large chunk of that.
Yeah.
But if the money's set aside for for 10 years or more, or 5 years or more, sort of a medium to long term horizon, and you really want to grow that, then you should be looking at growth ETFs, whether that's equities or alternatives. Could be property based. There are so many, whether it's global, Australian, emerging. That's the sector that's had the most growth, which is no surprise. I think Australians have been home biased for so long. The home bias is, I think, strong in every country. That makes sense. Like I said before, you invest in what you know.
Mm-hmm.
So Woolworths or CBA, Telstra, they're local, they're domestic. Those businesses. But we've seen huge growth in global equities in recent time. They continue to pretty much every month top the flow charts, don't they? As you know, you're the expert when it comes to trends. So I think so start with an objective, have a risk budget, so know the tolerances, and then look, when it comes to ETFs that are listed on Chi-X or the ASX, that they've already gone through rigorous checks to get listed. So the managers, from an operational risk and compliance perspective, are going to be really sound. I guess then you want to look at, okay, the objective of the ETF. If it's a passive ETF, they're all doing the same sort of thing. So it's a bit of a commodity, I guess. So I guess cost is going to be the main driver. When it comes to an active ETF, look at the objective. Have they hit their objective over the long term, or if they're only a recent product, just have a look at their short track record. Quite often you'll see that some of the ETFs that have come to market actually feed into a managed fund. So it's a sort of the feeder structure. So and that's what we've done with XARO and XKAP. So they invest in the managed fund, and the managed fund itself might have a 10-year track record or more. And so you can look at and look at it on a risk adjusted basis too. I mean, what is the manager saying that their risk budget is, or standard deviations? Just measures the variance of returns. Are they exceeding their objective over the long or medium term. No active manager is going to hit their objective, over every time period, all of the time. It is very hard.
Yeah.
But so looking at those 2, 3, 4, 5 year numbers, etc., probably a better gauge.
Mm-hmm.
And then it also comes down to things like on market liquidity. So looking at the volume on screen, looking at how many market makers there are, looking at what the average spreads are. And you can find all that information on your fantastic app, ETF Tracker. And then, the source data is from ASX and Chi-X, or Bloomberg if you've got access to a Bloomberg terminal. So it's those sorts of things. I think it's liquidity, the size as well also matters.
Size matters. Yeah.
It does, but that's not to say that shouldn't look at new ones, because from little things big things grow. And if you look at the trends, and some of the new ETFs are probably going to hit the market later in the year, they're also going to start really small, and so size shouldn't be an impediment either, as long as you believe that is an ETF that is going to succeed as well, I guess.
Yeah, that's right.
The only caveat there is that occasionally these ETFs do get shut down.
Yep.
Same with managed funds as well, whether they're active or passive. If they don't attract enough FUM, or funds under management, they may not be viable. So I guess, it pays to go with a big name, with a good theme, a growing theme, a team, like I said, at ActiveX, powered by Fidante, part of Challenger. It's a huge team.
Pedigree.
We're committed to the space. Pedigree. Yeah, we've got more and more coming. So things like that matter as well.
That's really interesting that you said that. Like a lot of people may not know that, but with the active ETFs, I don't know if it's all of them or maybe it is, but that they have not just the ETF component, the listed, the open-ended component, but the closed-ended and the unlisted. There is that track record there. So if you see something new that's like an active ETF and you're like, oh, there's not much data, whether it's through ETF Tracker or you're looking at your own kind of data sets there is more of a track record that can often be seen, isn't that?
That's right. Yeah. So that's certainly for the ones that are interfunded or feed into an existing managed fund. You can basically just look at that track record, because the ETF is going to get the same return as the fund over time, because it simply just invests in that. There are other structures where the ETF pool of assets is a separate pool of assets to the managed fund. We saw that with some of the equities, global equities ETFs in recent years. But then you can look at the manager to get a sense for their track record, even though the ETF it might have only had a couple of months or 6 months track record. So it's always important to have a look at the track record of the manager. And then more recently, we've seen Magellan, the largest player there in global equities in Australia, do something quite innovative, and basically take their managed fund and ETF and LIC and combine them into a sort of one structure, 2 units, and what we also call is the dual structure. So you can buy and sell units and on exchange or off exchange, and you're getting exposure to the same underlying assets. So that's something I think that we're going to see more and more with other managers. And another trend we've seen too is some of the global equities LICs convert to active ETFs.
Yeah, Monash did one recently.
Yeah. So I expect to see that, and Antipodes announced they were going to do that, subject to approval. That's more recent times. So
okay, I'll keep an eye out.
We could have a huge discussion on the appropriate wrapper for each different asset class, but that's a really important discussion, because not everything needs to be necessarily in an ETF. Some assets that are illiquid probably are better suited to an LIC or an LIT, or if they're capacity constrained, if you actually don't want these things to grow infinitely, grow too big. If it's a market that's quite small, you actually want a fixed pool of capital at work. the closed-ended sort of LIC structure can work, but for something like global equities, large cap global equities, yeah, the active ETF works really well.
That's brilliant. And yeah, there's a whole list of the different types of fixed income and global equity and all these different categories that are there. We make it easier to, look up some of that stuff, or you might have another app that you're looking at that has that. But very cool, seeing all this information there. Like, I'm definitely learning more about the fixed income space just from this conversation. And so hopefully our viewers will too, if they already know, they add further info, or if they didn't know, then they know that they need to look into it right now. Jumping into you were talking about like the types of innovations there, and seeing like active ETFs listing, and we're seeing new thematics coming out, like ETF securities, list the hydrogen type ETF. Just on all this growth, the markets are now just under 120 billion, will no doubt get to 120 plus when the August numbers come out early next month. But what have your thoughts been on, just being in the space for how many years you have, the growth of ETFs here in Australia? Did you expect them to, I guess, get as popular as they are? Were there those signs early on, or what are your thoughts on all that growth?
Yeah, look, I think it's just going to continue. I think, if you look back to catalysts, you had the GFC, which caused that first big, I think, shift and focus, real paradigm shift into that type of investing. And then we saw it again last year in the COVID sort of March drawdown, and a lot more people getting interested in investing.
Yeah.
And whether that was also just in direct equities, but also in ETFs. So I think you do need big catalysts like that. It's only going to change. And then if you look to, I guess, the more developed markets when it comes to ETFs, like the US and Canada, where ETFs make up a much larger share of the market. If we were to follow in those countries' footsteps, we could see our market going from about 120 billion up to sort of, I reckon, 4 or 5, maybe 600 billion in the near future. So yeah, I think there's huge potential that offer a simple way to access active management or index type management, passive management. It's so easy to trade via the exchange, and the exchanges themselves are getting more technological, and improving the settlement experience, and it's just so easy. A simple click of a button, buy units. 2 days later, the cash is taken out of your account, and you can trade throughout the day. It's it couldn't be easier. So I definitely think we'll see more growth. And I guess on what I think is going to come. I mean, we've talked about equities, domestic, global, fixed income, sort of domestic and global, and cash, but currently on the ASX and soon to be Chi-X. You've got other types, other asset classes. So things like currencies, commodities like gold, property and infrastructure. But probably where we're going to see growth and where the trend is heading is things that are, high tech, supercharged sort of fintech ideas, robotics, AI, genomics as well. So yeah, sort of biotech stuff. Crypto has to be thrown in there as well. That I know there are a few that are being looked at currently by ASIC and the exchanges. Applications are in, so we might see later in the year 1 or 2 crypto ETFs. And again, that'll make it so much easier for the average retail investor to access that asset class and not have to worry about things like cold wallets and security around
passwords and stuff.
Exactly. Yeah. So yeah, I think the trend is a friend. We're going to continue to see more growth.
Good line.
And another area that I should mention is ESG. So yeah, in investment strategies that are focusing on the environment, combating climate change, that are helping build a more sustainable world. I think they'll continue to be really popular. We've actually got a couple of ideas in mind as well that in that space that'll be coming hopefully later this year or early next year.
Yeah.
The global sustainable investing.
Watch this space then. For all of you heard it here. The Bitcoin one's interesting, right? Because a lot of these times, like, and you mentioned before, like ETFs can delist if they're not popular enough, if they're not getting the flows in. But when a new ETF lists, following on from some trend that's been seen in the market, sometimes people talk about, oh, it's too late. It's like, well, it's not, because these thematic ETFs, you see them grow. So even if they do list after the trends kind of been hitting in the equity markets, you see these things still grow and perform. But with the Bitcoin one, it's interesting because, yes, they've still got to deliberate overseas in the US and also here with the consultation paper from ASIC. But if it does list, it's already got like demand there. There's already a lot of people and, different generations, but mostly the younger ones that are wanting to get in there. But that'll be interesting if it does kind of list. And ESG, as you mentioned. Look, the thing that is really interesting is seeing all of your kind of thoughts and ideas on this kind of stuff. If people are interested in learning more about fixed income, learning more about like strategies that you guys talk about, they want to follow the insights that you put together at ActiveX and Fidante and just learn more about that, and maybe the other 17 kind of things that you guys do, because ActiveX is one of the 18, right? Where can they go to learn more?
Yeah, thanks. So the website, our website is fidanteactivex.com.au. So that is where you'll find more information about our two active ETFs, so XKAP and XARO. On there, we do have other resources, about what is fixed income, what is an active ETF, more detail on what we've discussed today. I think that'd be a good place to go if you want to find out more about those managers themselves. So Ardea manage the XARO ETF. They have a website, so look up Ardea Investment Management, and Capstream Capital manage the XKAP ETF. I'd also look at the ASX and Chi-X for more resources as well. So the ASX has a fantastic website, really good resources on the trends, on liquidity, market makers, what is a market maker. They've got a really good glossary, and they even have sort of tutorials where you can learn more. Chi-X also has some great resources, and then of course your website, which I've been a fan of for a while now.
Thank you.
Distills that information and into a really nice interactive format. So that's good to use. I use that quite a lot to see where the money's flowing.
Oh, brilliant.
And then I guess you could also go to US websites for more information as well, and look up what's happening in the US. So ETF stream, or just look up ETF trends. That's what I'd do to find out a bit more. There aren't really, I can't think of any good books, so you probably don't really need to read any books. There's so much content on the internet.
Yeah, exactly.
About this that you can find.
No, that's brilliant, and I'm sure that
sure there is a book, ETF for Dummies. I'm sure that does exist.
There probably is, and if it's not, maybe we need to write it. But I'll put those details in the show notes. So if you're listening on Spotify, look at the notes, or YouTube, then the notes will definitely be there. But yeah, make sure to follow along. Matt, thank you very much for all this brilliant insight. Like I said, I've certainly learned a lot, and I hope our viewers have too. So again, thank you, and looking forward to chatting more.
Yeah, thanks a lot, Mark. Thanks for your time, and thanks everyone for watching. And yeah, look forward to doing this again soon.
Okay, cheers. See you later.
Great. All right, see you.
Well, that was awesome. So we hope you learned a lot about active and fixed income and what things that you need to look out for if you're assessing an ETF to go into your own portfolio. So there was a lot of lessons there. As I said in the show, the details are in the show notes, so make sure you check those out below. And yeah, if you're interested in more of this kind of stuff, follow along. We'll have more of these kinds of interviews in future. Cheers.